Welcome to the Multifamily Management Excellence Podcast. Are you interested in learning from multifamily experts and how they achieved success? Then you have come to the right place. Your host, Mike Ballard, interviews industry experts to share their stories and advice to achieving success in the multifamily industry. Our goal is to provide you with resources and tools to increase profitability and achieve success on your own multifamily journey.
Hey, I'd like to welcome everybody here this holiday season. By the time you hear this, probably Hanukkah and Christmas are over, and we're getting ready to celebrate the new year. My name is Mike Ballard. I'm a partner in Ascent Multifamily Accounting, and I'm also a CEO of Camino Verde Group. And we're excited to have our guest today, Bruce Fraser, managing partner of Elkhorn Capital Partners. He's the founder. He's got an interesting background and a lot of fabulous insights. One of the smarter guys in multifamily that I've ever dealt with. So with that, Bruce, welcome.
Hey, great to see you again, Mike. No
Nice.
pressure after that comment.
Yeah, so, but it's well-deserved. We're glad to have you. Number one, it looks snowy in the background. Where are you today? Because aren't you headquartered in Dallas?
I am headquartered in Dallas, but I'm in the mountains in Colorado for the holidays with my family.
Awesome. That's great. It looks beautiful. Looks beautiful.
Yeah,
So
we love it here.
tell us a little bit about you know, kind of what, before you got into multifamily, what brought you to this? Where'd you go to school? Where'd you go to work? What kind of things did you do? That type of thing.
We've always been financially focused. I think I just came out that way. Even when I was a young teenager, I was reading financial magazines and kind of was always searching for better and better content. But my undergrad was at SMU, eco finance degree. So that's why I still think a lot about the macro environment and how supply demand shifts, and all those sorts of things that you don't usually hear real estate guys talking about. And then graduate degree at SMU as well, MBA in finance, and worked at Fidelity for a number of years in the early days, and you just kind of get it in your blood, the stock market, investments, and trying to figure out where things are headed. And so,
what role at Fidelity did you have? What kind of things did you do at Fidelity?
Fidelity is it's a great company. It's shocking when you think about how big they are. Probably everybody you know has a Fidelity account, but it's a privately held company. And as a young person starting off a career, I didn't really think about that till I got inside. You start looking at the just enormous wealth that they oversee, and what an incredible responsibility that is. The data centers and the redundancies and backups. They literally have data centers all across the country where half of one side of it could be on fire and it wouldn't affect the other side. Just things like that, because you lose that data. And it affects people's wealth. So, but the role I was in, ultimately when I left, I was an analyst helping run a new startup organization within Fidelity that actually grew to be quite sizable. But we were just trying to figure out how to best address the market for investors. I wasn't on the investing side. I was internal ops.
Got it. Super. So then how long did you overlap Fidelity with real estate investing? And why?
I didn't actually. I left Fidelity when I finished my MBA. I had advanced within the firm, and it just, like I said, it's a great company. I have no hard feelings there, but they just couldn't keep up with market on salaries and whatnot. Their benefits are great, but tech heyday was just starting, and so I made a move to a B2B company, a supply chain management company at the time, and into a finance role, and really learned a ton. We were doing fairly quickly thereafter started doing M&A, and I was doing M&A of tech companies, flying to Silicon Valley, spending most of every week there. It was a lot of travel, but at least on paper, it seemed to all make sense because everybody's stock options were worth a fortune until they weren't. But that was I learned a ton. Some of it, what not to do. But while I was there, I actually started. I had been working on my graduate degree, as I told you, and I started working on an investment strategy while I was in grad school for a couple of the classes, and just continued to work on it because the results were really compelling. And I had a friend at Fidelity back in the day that introduced me to someone in the hedge fund community. Said, "Hey, I know this guy through the art community. I think you get value from meeting him." Well, come to find out, he's just uber wealthy guy that made all his money trading a fund, and gave me some advice and small investment to start. And just it was validating at that point in time that I should move forward with it. So I started the hedge fund and ran that for about a decade successfully, including through some pretty crazy periods. Great financial crisis. We were at our highs with minimal drawdowns, and so when you do that sort of thing, people ask you, "Hey, what else are you doing with your money?" And
Yeah.
so that during that period of time with all the distress, we knew the Fed would start printing money, and I had sold all my investment real estate in late 07. I was just doing some smaller stuff with one business partner at the time, but didn't want to start investing in 08 or 09. I thought prices were still heading lower at that point in time, but I formed Elkhorn in 2010, and no looking back. So
Super, 2010. Okay. So tell me about Elkhorn Partners today. I mean, what was the first deal you bought? And tell us about that first acquisition and what it was like, how long it took you, how many deals you looked at to get there, that type of thing.
Yeah, well, we're singularly focused on multifamily at this point, but the first deal would have been not multifamily because the banks weren't lending those first couple of years. They were still bleeding from the financial crisis. They were still dealing with their own issues, and so everything had to be done cash. So the first couple of years, it was much smaller transactions, things like that. But my first multifamily deal, I remember, it was a deal over Fort Worth, and we paid $5.75 million for it, and 14 months later, someone offered me 7.9 for it, and which at the time I think was about a 4 cap, and it didn't make sense to me that someone would pay that much, and so we felt, as a professional investor, I felt obligated to take their money and move it to somewhere I could make a incremental higher return, or I felt more comfortable with it. So that's what we did. We actually ultimately, probably prematurely, but left the Dallas Fort Worth market. It just seemed more like a momentum stock to me. It just you're buying something, and I know the business fundamentals. I live there; they're great. Tons of people moving in every day, and those people have to have places to live. But if at some point the music stops, generally those deals don't make sense just to hold them. You're buying them with the intent to sell, and that's where you're making your return. And sometimes music stops, just like it did the last year or two when the Fed started raising rates so rapidly. Transaction volume, I've seen all different data, but I would guess dropped 80, maybe 90% a year before last. And so if you were in a property where you had to sell within a certain period of time to make your return, you're not going to do that. So, for us, we had planned to sell a couple last year, but it's like, well, we'll just wait because they're doing well, and we'll sell into a better market.
Super, super. So tell me about why you chose to be exclusive in multifamily.
That's a good question. Risk reward. I think it's a great business. There's several reasons. First of all, you get to real estate if you're worried about inflation or the currency debasing over the years. So you want something real, something hard that's store of value, and that could be timber property, it could be oil and gas mineral rights, it could be income producing real estate, any of those things. And I felt like I had more knowledge in the real estate environment, and so I like that asset. It's not rocket science. Most anybody here on your podcast has probably lived in an apartment at one point in their life. So it's just a matter of why do I want to buy this one? But so I like the simplicity, well, theoretical simplicity of it. But I was, I steered away from office and retail just because they were too cyclical and tied to business cycles. Now, I had no idea that the paradigm shift working from home was going to occur to the magnitude that it did. I wasn't pressing it in that regard, but I just didn't like the cyclical nature of those categories. And then also, if you own a retail strip, let's say if you're worried about inflation, which I was and am, you might own a strip center with a CVS and anchor tenant, and they're probably going to have a 20-year lease there. They don't do 1-year leases or 2-year leases, and in that lease, we'll have predefined step-ups on the rent each year, and most likely those are going to be in line with CPI or something less. And so if you experience inflation like we did the last couple of years, where it's arguably well into the double digits, you're getting hammered. And so your hedge isn't hedging you. And so I like, just from a macro perspective, I like multifamily because I might have a 200-unit property. So I've got someone coming up for renewal almost every day, and I can adjust to the changing market immediately with my pricing. So there's that. And then just simply, people have to have a place to live, and there's no going back on that. And I think that I don't like it socially, but what I'm observing is that we're really creating a whole generation of lifetime renters, most likely, because they haven't been able to save the funds because of the disruption during COVID and things like that. And then you couple that with the massive price increases that we've seen because of inflation, and saving for a down payment and living that American dream is very hard to see that path at this point, unless they're being helped out by their parents or something like that to get started.
Right.
So you have that happening, and then you have that same generation has really been trained to rent everything. Their music, Spotify. They would rather have Spotify and have access to any music they want to at any time than to buy an album or CD, whatever we call it these days, and
Right.
And have ownership of it forever. So they're used to the perpetual payments. Wall Street loves it because companies that have that kind of perpetual revenue get a higher multiple versus the one and done. But so I think that fundamentally, everything's lining up to be on the right side of that. If you are, I'd rather be the owner than the renter. So we focus on multifamily.
Beautiful. Thank you.
Yeah.
So tell me about Elkhorn Capital today. How many units, how many properties, what's your organization look like?
Yeah, I think, we recently had 11 properties. I think we're down to 9. We sold 2 this year, but we have one that we're adding back, a new one, next week. So, it's always kind of a moving number, but we've been around 2,000 doors, roughly, just under, all concentrated in 2 markets. And we do expect to get bigger, but at the same time, we have periods where we do sell stuff. It just depends on the asset. Some we buy to hold, and some we buy and say, hey, we'll probably be in and out in 3 years. And so we have to adhere to that.
Beautiful. And last time we talked, number one, you're buying assets typically around 180 to 280 units, right? Something like that.
We say 100 to 300. I don't really want to be below 100 just because it's inefficient with your staff. And above 300, you're competing with institutional money that really their required return is much lower than I like to make. And so I think the niche is 100 to 300. But we do really like that 150 to 250.
Okay. And last time we talked, you talked about how you're planning on doing a lot of acquisitions in 2024 for some of the reasons you've already discussed. So you want to tell us a little more about that?
Yeah, Elkhorn is known to be known to focus on distressed situation acquisitions. That's what we do. We kind of got in that niche over the years because all the pretty stuff was trading at prices that we just couldn't get comfortable with because we're very conservative. And so we would rather buy something broken and fix it, knowing that there's a clear path to money, than to speculate and buy something that we just have to throw a new fancy amenity, new shiny object at the tenants and hope they'll pay us for it. So that's why we ended up in that space. And there aren't many people that play there just because it is an incredible amount of work in that first year or two. But it's been a really clear path to equity gain for us. And we've made some great returns doing it. Plus, there's the positive impact too of you are in theory, making the world a better place because you're bringing an asset that's distressed and decaying potentially, or a problem for the city. You're kind of bringing that back on to be a productive asset. So we like that. But what we're seeing is not everybody took that conservative approach in the last few years. A lot of people were bidding on deals and paying prices they frankly shouldn't have been paying. But the only way to make them work and to pencil the number would be to get a lower interest rate. And the way to do that was to use floating rate debt. And so a lot of people a shocking number of people, frankly, were on floating rate debt. And instead of locking it in when we were at historic lows in rates. And so that has come back to bite a lot of the operators in the business. And so a lot of those operators are having to do capital calls to their investors, or they've lost their equity for their investors already. But they're certainly not in a position to be out buying assets. And so being known for distrust and being in a situation where we've been in 100% fixed rate coming into this just because we're conservative and our entire portfolio is running at literally all-time highs, we're in a great position to take advantage of this. And I hate that it's happening to some of these other operators and certainly to their investors, but we're positioned for it and we're getting the calls and prices are lower now. So that's very helpful. So we want to take this opportunity. Our view on inflation has not changed. We still think that it's going to stay high and sustain for a long period of time, even though it's come down near term, for the CPI at least.
We're gonna talk a little more about that down the road.
Okay.
Continue talking about the current situation as acquisitions.
Yeah, so based on the macro context, it's still in our thesis that we want to own hard assets, and so this is an opportunity. There's a sale going on right now, and so we plan to add as many as makes sense for us.
Beautiful. Thank you. So you've chosen to self-manage your properties. Is that right? Tell us about the decision that went into that.
To some extent, it was a forced decision. It's a business we never wanted to be in. You and I talked about it, but we just couldn't really find competent people to run our properties for us. As the years went on, we became more and more experienced, and we knew what needed to happen to address the assets and to help them get the performance that we're seeking. And we just felt like we're pushing on a string. We would give instructions to our third-party managers, and they wouldn't follow through. Months would go by, and just that it's lost potential revenue that you just can't get back. And so it just got to the point where it was super frustrating. It was keeping me up at night, and so we started looking at the potential for doing it. And once we figured out the right structure to do it, I got comfortable with some of the HR side and things like that, the way we structure things, and so we did it. And honestly, this same month we flipped the switch. All of our properties improved, every one of them, and it was shocking. And here we are. We made that change beginning of second week in March, and I think our entire portfolio revenue is up around 30% even since that time. It's
Wow.
nuts. Yeah, it's made a huge difference, and we feel more engaged with the people that are running our assets for us. I mean, they're the quarterbacks down there. I mean, we might have a $20 million asset, but someone making not that much money is site manager, and they're going to create the success or failure of that property. And so we want to make sure we pay them well and financially incent them to get the results that we want, where they can participate in the success as well.
Awesome. So if you were to advise somebody else thinking of doing self-management, that's a little frustrated that they're doing what you said, right? They're giving instructions to the property manager, and it just they seem like a molasses. It's going so slow to get the change they need. What advice would you give somebody thinking to self-manage?
Talk to other people doing it, learn from their mistakes, so you don't have to make those costly mistakes yourself. I would say get great technology. We have seen multiple property management platforms, and some of them they look like they're from the 80s, 90s, maybe. So get fresh tech. It can make a huge difference in your visibility into the property as well as your ability to manage it. Some of them have AI features, which are nice for maintenance and things like that. But then also your team is just critical. You have to have somebody to help you. That's in the. I mean, we have an asset manager who's invaluable to us, and she's up in the market. She does most of our hiring and firing. She knows a lot of the managers because she's been in that market for years, and that's been a huge help to us. And a lot of the reason we have had the success that we've had. But then our team that's not up in the market as well. Just that they're very smart, and they try to think how to do things more efficiently. Because I mean, let's be fair. I mean, you don't come out of grad school and say, "Hey, I want to go into property management."
No,
it's not where you want to usually, because everything about real estate that's negative that people talk about. Oh, I don't want to get this phone call. I don't want to get that phone call. And like, it all lives in property management, and so it's not the hot dot for people to seek. But for us, it was really just about our investors and driving the value for them. We knew that we could do a better job, and we've proven that. And so for us, it gives a lot more flexibility, a lot more control, and you sleep a lot better.
Okay, and so you stressed people and technology, look for that to make it work. Okay, let's talk about.
One last thing to tie off on the people's front. I mean, I said that about incenting your employees, but I've seen the opposite in the industry because they're so focused on low expense that they don't pay their people well. And at that point, that job for that site manager or that maintenance guy, they could go replace that income anywhere. And so they really aren't committed to the job. And if they get frustrated one day, they demand to leave. And so we would much rather have somebody that incent them while they're making more money than they could make somewhere else. And if they are doing that, and we've set up our comp plans right, then we're benefiting even more than that. So that's the plan.
That's great. Thanks. So let's go back to the macro environment, right? Because that's where I think I just have, I love listening to your discussions. You post on LinkedIn, you do podcasts and other things, and the insights that you shared over the last couple of years, I just said, he gets it. He gets it in a way that most of us don't quite get it. And so talk about what you see for 2024 based on the macro environment. If you wouldn't mind. 2024 and beyond. And beyond.
Whole crystal ball. Well, I think the macro drives everything, and again, that's why I'm focused on real estate, is because of my macro view. I didn't flip a couple houses and end up here, and I think a lot of people lose sight of that. I was at a conference 5-6 years ago where everybody was saying how late stage real estate was, and they were just looking at the very finite, valuations within that and everything. They weren't thinking about the currency and inflation and what really is the tail wagging of the dog wagging, you know what I mean? The big driver. And so, in my view, I think if you look at the data, we're very data driven, both because of the background, the hedge fund, and just my degrees in school. And so, you listen to all these people, you listen to the narrative, CNBC, Bloomberg, wherever you get your information, but it's just noise. At the end of the day, most of the information is available, and if you go dig and do the work, you can see what's happening, irrespective of what Powell says. Or he says the financial system's solid and under control, but then the Fed reports say they're, I think, 760 or 780 that have had more than a 50% impairment on their balance sheets with the bonds that they hold. It's just, the data is out there. You just have to look and see. And so, what do I think is going to happen? The lending environment's gotten very difficult. This happens every down cycle. It happened during the COVID lockdowns. We bought 4 deals during COVID, would have loved to have bought 12, but just working with the lenders was very difficult. This acquisition that we're working on right now, same kind of deal. There are a lot of lenders that are just not in the market. They may say that they are, but they either slow play their term sheet to you, or they give you terms that would tell you they're not really lending. And so
let me give you one quick, I got to give you one quick example. We're working with a local bank here. We're working on a 279 unit active adult luxury market rate community. And we got a local bank who just has been challenged a little bit. They were in the news a few times, their mother company. And their term sheet to us was, we'll do this $36 million loan, but we need you to bring 10 million in assets into the bank, in deposits. And I'm like, what?
Well, and you know why that is, right?
Yeah.
Because banks play that game, but it's self-funding at that point, because banks are what's called ratio reserve lending. And so if they bring in $1 million, they can loan generally 10. And so if you bring in 10, they could go loan a ton of money incrementally, which helps them fund the deal that you're
right.
wanting to borrow for. It's all a big game.
So.
Yeah, I hate when I do that.
I interrupted you. So talk about these regional banks, because regional banks have been typically the source of a lot of lending in different periods of time.
And they work
just
for
shut
us
down.
too. To some extent, we had pivoted to using regionals because they know us in the markets we're in. They can go walk our other assets. They see what we do. And Fannie Mae and Freddie Mac they held everybody to different rules during the COVID lockdowns if you had any agency paper on the property. And we didn't really like that. Plus the regionals they just had better terms post COVID. So we increased some of our relationships with them. But the issue is, just like we saw, February or March of this year with Silicon Valley Bank and some of them, a lot of these banks, they have a lot of cash and they haven't deployed it all. And so they turn around and they bought mortgage-backed securities, long dated stuff, to try to get yield. This is before the Fed started raising rates. And so maybe they had a 10-year bond or portfolio of 10-year bonds or something like that. And when the Fed increased rates so rapidly, the face value of those bonds got impaired radically, 50% or more, depending how long the duration
exactly was. You could buy a $1 million bond, and 6 months later it was worth $500,000.
That's exactly right. And so banks during the financial crisis or post-financial crisis were allowed to kind of hide that loss. It's what's called held to maturity bucket. So they move it over to their balance sheet in this other bucket where nobody can see that loss mark to market, which is great until they have big withdrawal from somebody and they have to sell some of that to turn around and fund that liquidity that they need. And so that's what happened at Silicon Valley Bank. They had some people that were withdrawing money. They had to sell those at massive losses. People got freaked out by the losses they were taking. And then it just started to run on the bank. Because we don't only go in the banking industry, but most people know it's ratio reserve lending banks. And so that means, all the money's not there. They've loaned out more than what they have. And so if everybody wants to get their money on the same day, it's just not there. And so it's a bit of a house of cards that can be blown on periodically and could cause a lot of trouble. So that's what happened. The Fed stepped in and backstopped it, calmed everybody down for a bit, but it's a problem. And so even though the Fed is backstopping it, it doesn't create an environment where those banks want to lend, and so a lot of the regionals are out. Freddie Mac and Fannie Mae are pretty much always there as lenders. Their terms may get more onerous, which they did during COVID, or now, but they're there. So, and then you've got the kind of the bridge lenders, and then even hard money lenders, and depending on where those guys source money, sometimes we saw what's happened in COVID as well. I would say probably 2/3 of the bridge lenders evaporated within a matter of days because they were out there borrowing money and then turning around and lending it. And so their source of capital dried up. And so really what we're trying to do is work with lenders that have their own balance sheet. They're lending their own money so that that dial doesn't get turned off, because you could be about to close a deal and their line of capital gets cut off, and then too bad. Doesn't matter if they had a commitment.
I've seen 2 of those happen just in the last month. It's pretty crazy.
Yeah, and I mean, we had a personal situation, or a situation with Elkhorn. There's a lender that we like working with. They're not the cheapest out there, but they know us well and really have seen what we've done. So we went to them on a deal. Their cap used to be 15 million, and they had been reduced to 12 just for risk management reasons. But they said, hey, let's see if we can get approval for it. They went to their board. They got approval for it. We were just about to close, literally within a week or so. And their source of money, their warehouse line, said, no, you're not authorized to make that call, even though the board said yes. And so we had to go get a different lender. It's it's really more comfortable to be dealing with lenders that have their own balance sheet right now.
Right.
Yeah, good times, it doesn't matter. It's just times like these are a little bit more tumultuous. You really need to have a relationship.
Right.
But you asked me about my view on 24. I don't think I ever answered that. So we see a lot of distress. I would say we're probably 4th inning at this point on that. It really is very pervasive. A lot of operators, a shocking number, like I said, didn't get their capital stacks right, or they were buying a deal hoping to do a traditional value add, and they execute their business plan. It's working. The revenue's up. It's just not up enough to help offset where the refinance needs to be to cover the debt service, and so they can't get the same proceeds that they needed just to take out the original loan. And so they either have to come to the table to refinance with a bunch of money, or they have to force sell it, or
it's the new cash in refi. We were all used to the cash out. We were used to the cash out refi, and now we're learning about the cash in refi.
It's going the other way.
Yeah,
going the other way. And so there's a lot of pain. I think it's going to get worse. The door is not very big for them all to get through, and not everybody's trying to get through the door yet. There are a lot of people that are still thinking that it'll resolve, and they can just carry it another couple months. Maybe something good will happen. But you do have the Fed in a situation where they've openly said they're on pause and probably they're already talking about cutting. And so the dot plot right now would imply that they're going to cut 3 times next year. If they do, that'll save a lot of the deals around the fringe that are just kind of on the bubble. But the people that have been deeply impaired, it's not going to be enough. But I do think rates will decline next year, not only because of the level of the stress that's out there, and it's just that the Fed believes that they're done with the inflation battle based on the metrics that they follow. But not the least of which is, you've probably heard me talk about the U.S. government debt. It's 33.9 trillion, and 5.5% on that's what 1.9 trillion, and just in interest only debt service. You put that in context, they collect, I think, 2.2 trillion ish in corporate and income tax together per year. So it's of the scale that is really tenuous. And so
how does the federal government get through that in the next 2-3 years?
They have to have inflation.
They have to print more money, right?
They have to monetize their own debt. There are not enough buyers to buy all that debt, so they're going to have to keep buying their own debt, which is inflationary, because to buy their own debt, they have to print the money to go buy it, and so it's inflationary. I mean, they can raise taxes and cut spending, they can default, or they can inflate, and they can't. I just gave you the math on why they can't raise taxes sufficiently to solve the problem. I'm old and gray at this point, and I know, I've seen a lot of cycles, a lot of different people in office. They're not going to cut spending; they never have. And they don't want to explicitly default, so that only leaves inflation. And so the game there is to have a high and sustainable level of inflation, but not show it on CPI. Because if they show it on the CPI, then all their entitlement payments get ratcheted up too, which is counterproductive to what they're trying to achieve.
So how do they do that? If they inflate things that don't affect CPI? What are they inflating?
Oh gosh, they've changed the calculation on CPI dozens of times over the years, and every time it results in a lower number. I mean, CPI is not, in my view, a fair representation of inflation. I mean, when it was at a high a year or so ago, it printed what, 9%. When it was printing 9%, well, let me back up. A third of the CPI calculation weighting, it comes from owner's equivalent rent, which is a bit of a Frankenstein number, but it's supposed to represent your cost of living in a home or renting an apartment. So when it was showing 9% on the CPI, they had said that the owner's equivalent rent had only increased 2%. Now you find me a market a year and a half ago where it had only increased 2%. I have no idea where that is, because everything I was seeing was substantially higher, 20, 30, maybe double. And so it's just an understated representation of inflation. But most of the goods I was buying at the grocery store, clothing or whatever we were buying, it was 25 to 30% increase is what we were seeing on most of the stuff we were buying. I don't know if that is scientific or not, but there are people out there that have other measures. There's a Big Mac index you can follow. There are people that follow the same set of goods year after year and go to the grocery store to see what they cost. One of the games out there is a shrink inflation too. So if I want to go buy a thing of ketchup, well, maybe last year it was 24 ounces, maybe this year it's 20 ounces. Same price, but per ounce it's costing me more. So there's a lot of games where you have to really pay attention.
Yeah. So a lot of our investors, right? We syndicate, we have different folks. They have a choice between investing in the market and investing in real estate. Talk about that. What you think the market's going to do? Because I know you still dabble in the market and have a history in the market. Talk about the stock market investing versus real estate investing in this environment.
Well, there are a couple of things there. Fundamentally, if the Fed achieves what they're wanting to achieve, they'll slow the economy, which could be restrictive for business earnings. And so that's a negative on fundamentals. But if you think about it from a numerator denominator basis, if you flash back to high school or college, everything's denominated in dollars. And so if something has an intrinsic value and the value of the dollars goes down, then the price could actually go up, even though the relative value hasn't changed. If I wanted to trade a steak for 8 apples or whatever, it's still probably that ratio's there, but it might cost me more dollars for each. And so that's inflation. So in a high inflation environment, or even certainly in a hyperinflationary environment, stock market can go vertical. Now, it wouldn't make sense on a valuation basis necessarily from fundamentals, but it could happen just simply because it's denominated in dollars. But that said, I do still have a business in the public markets, and we have a very effective approach. But I like, I guess, the purity of real estate, where we can go look at a situation, work hard, and actually force value creation there. Whereas in the equity markets, you can be good at it, but you're really just improving probabilities. You can't control the outcome. If you're controlling the outcome, it's illegal. So, I like that. And then I wrote a piece several years ago called "Confessions of a Hedge Fund Manager," and in that I walked through the math on it. If I compared investing in the stock market to real estate, and I have $100,000 to invest, I can put $100,000 in stocks. Unless I'm doing hedge fund stuff, I can buy $100,000 worth of equities. In real estate, if I put $100,000 into a real estate asset, I can generally buy a $500,000 real estate piece of real estate, maybe. And so if both appreciate,
say that again. You can buy 5 times the value of the asset.
Right, because the bank is loaning on the real estate because of the true value there. And so if they both appreciated 20%, and the equity markets, I made 20%, I made 20 grand. If my real estate increased 20%, I made 100 grand. I doubled my money. And so, because that $500,000 asset improved in value to $100,000, and I had only had $100,000 in it. So it's a much, that is because of the leverage that's available in real estate. But it's, if you handle leverage prudently, which you certainly can, and don't get over levered, then it could really drive higher compounded returns. There's also massive tax benefits to being in real estate versus equity markets. If I made double my money in the equity markets, well, let's say I make $1 million. Well, I'm going to have to pay $400,000 probably to the tax man, and I have $600,000 at the beginning of the next year that I have to make $400,000 just to get back my tax that I just paid. Whereas if I'm in real estate, I make $1 million. There are all kinds of ways: depreciation, cost seg, 1031 exchanges, where that next year I'm investing $1 million again. And so I don't have to, you can avoid a lot of the income tax. Now you still have to pay property taxes and things like that, but it's much more tax efficient. It allows you to compound more rapidly.
Super. I'm going to do, you and I have talked, we've got a mutual friend that we've both done business with. I find the multifamily business to be very much the abundant, a lot of the players have an abundance mentality. And yeah, we're competitive to get a deal, but then after that, people will often work together. And you said early in your career, you had a guy that came through for you when you were needing some help closing a deal. Can you tell that story about our mutual friend, Bill Fisher?
Oh, Bill, holy cow. Yeah, I forgot we talked about that. I didn't know which friend you're talking about because we have a couple mutual friends.
We got a bunch, but Bill's a great guy. Yeah.
Yeah. So, it was a situation where in multifamily with lenders, certainly with Freddie Mac and Fannie Mae, you have to be in the club to participate, which means you have to be an owner to buy new stuff. And so that's kind of complicated where like, how do I ever get in the door? And many times you see this happen with syndicators and other people that partner with somebody. And you mentioned Bill, he is a very large developer of low income housing and one of the biggest in the nation, I think. And so we had the capitalization, we had the investors, we had the deal, but we couldn't check that box early on experience. And so with multifamily, I'd done plenty of real estate, but hadn't been an owner. Sorry, my dog just came in. But yeah, he was just gracious enough to do that with us and partner with us on that deal to help us get that done. We're at that point, once we have that deal done, we're in the club and we can be off and rolling. And so yeah, I'm very, very thankful for him to have done that for us to help me get started, build what we built.
Beautiful, thanks. Yeah, and I find a lot of people do that, right? So if we're a lot
of, I'll say it. I speak on a lot of panels. Sorry to interrupt you, but and like you said, I post on LinkedIn up here. I have people call me. Hey, I'm dealing with a situation. Can I? I don't know them. Hey, can I call you to talk about it? And I'm not soliciting a lot of that to hit me, mind you, but I feel like it's kind of good karma, right? I mean, if I can help somebody solve a situation that I'm not involved in, then that's great. I feel good about that, making the world a better place.
Yeah, and look, and I've done that too, where I've probably been now the key person on 5 or 6 deals to where I help them guarantee the loan because they need experience or net worth or both, or cash flow and that type of thing. And so we've helped, smaller groups just getting started all over. So, our advice to those people that are new to the business, need help kind of getting the step up, whatever that is. There's a lot of players in the industry, and I think you'll agree, Bruce, that, we're happy to help in one way or another.
Yeah, absolutely.
Yeah,
I definitely agree.
Okay, so I always ask our guests if they would recommend what's a book that was important to you early in your career. Have you thought about that? Can you, what book would you recommend for people that are early in their careers trying to
I've been asked this before,
make it in business?
And one of the ones I used to recommend, just because it changes the way you think about the entire financial structure of the country, is The Creature from Jekyll Island. Now, I think it's a lot more pervasive now. A lot more people have heard about it because people have posted about it. But it discusses the creation of the Federal Reserve, which is not a government organization.
It's a darker book than I expected. Yeah,
and it's not a reserve. It's I mean, it is fairly dark. It's not a light read at all, but it helps you understand kind of the games that are going on economically in this world. And I mean, it's literally, the quick summary is JP Morgan, not the bank, the person, and his cadres, back in the day when they're just all uber wealthy individuals, got on a very private train and headed out to Jekyll Island, which is an actual place, and had a secret meeting. And they basically created this organization called the Fed that was to backstop all of their banks when they took losses. And that was basically the gist of it. And so it really changed the way you think about banks and banking. And so I think that's a good one. I think also, maybe not as deep macroeconomically, there are a lot of them that I'm sure a lot of other people mentioned, but because of my background in the equity markets, yeah, I'm always curious to read about things that have happened in investing in general. But when Genius failed, or any other book about long-term capital management, which was a massive hedge fund that had great theories, and they had Nobel Prize winners that, just these great, highly educated individuals that thought they knew exactly what they were doing, didn't really stop to look at the holistic picture, and they blew up spectacularly, where the Fed and the other big banks had to come in and save them, because it was a systematic risk to the system.
So that book
But
is
I think
When Genius Failed?
When Genius failed, or there's several.
And who's the
on
author of that? Do you remember who the author was?
You don't.
Okay,
let's see.
it's okay. Don't worry about it. We'll figure it out. So
Roger Lowenstein.
got
But I think it helps you really personally, mentally try to stay grounded, where you don't get that attitude of, oh, I'm so smart, I know exactly how things are going to play out, and I'm not going to focus on the data. Because basically what happened with that fund, their theory was fine, but what they didn't realize is, well, they should have realized, was that they were the entire market. I mean, you can look at the volume; they were the entire market on what they were buying, and so there's nobody to sell to. And when they wanted to sell, there's nobody there, and so it became a big problem. So you can get, it helps be a reminder not to be too egocentric about the way you think about things, and always be cautious.
Good. Well, thank you very much for your time today, Bruce. It's been fascinating and nice to see you. Have a great holiday, and we'll post this shortly. And to all our viewers out there, this is some great insight. Hope you incorporate it into your businesses, and we wish you all the best. Thank you very much.
Thank you to Ascent Multifamily Accounting for making this podcast possible. Ascent has a team of multifamily accounting experts that provide outsourced bookkeeping for multifamily management companies. To learn more about Ascent Multifamily Accounting, go to multifamilyaccounting.com. We hope you have enjoyed listening to the Multifamily Excellence Podcast. If you want to hear more from multifamily experts like this, you can find our podcast on Apple Podcasts and YouTube. We appreciate your support and can't wait to have you join us again for our next episode. Until then, take care.